The New England Business Group presents It's All About Business. Our presentation today is Funding Sources for Your Business Idea, Part 2. Welcome to the sixth presentation, Funding Sources, Part 2, in the New England Business Group Pre-Startup Series. This session will continue our discussion of potential funding sources for your business idea, while the entire seven presentation series will help you evaluate your business opportunities so that you can reach a go, no-go decision. I am Larry Gable, President and CEO of the New England Business Group, and I will be your presenter today. Our lecturer today is Alfred E. Newman, who said, "Remember, entrepreneurs, you can be on the right track and still get hit by a freight train." The New England Business Group has crafted a pre-startup process to help the entrepreneur organize thoughts and prioritize activities in order to optimize the idea development and research processes leading to the go and no-go decision based on market research. The result is an informed decision process that is geared to the realities of the marketplace. The net effect for the entrepreneur is to have acquired an enhanced information set upon which to build a business plan. The work and effort invested in the business research and analysis is not wasted, but rather immediately useful in the development of the business plan. So the Funding Sources module is the sixth of 7 modules. It is designed to help the entrepreneur focus on funding the business idea being studied. It introduces basic funding concepts and sources and rationalizes the business funding sources with the potential returns and growth prospects. The module continues the specific discussions of the various funding sources in an example of venture capital funded businesses. About the time we can make the ends meet, somebody moves the ends. A quote from Herbert Hoover, a President of the United States. So let's look at the startup funding cycle. From lower left to upper right, you can see what is labeled as Valley of Death as you work to start your business and get to the break even. And then you see, as we move up and to the right, first, second, third, and eventually mezzanine. These are forms of financing as you tend to grow and become a much higher interest company. So A round financing, that would be the first round on the chart, second round, third round. A round financing is the first major round of business financing by private equity investors or venture capitalists. In private equity investing, an A round or Series A financing is usually in the form of convertible preferred stock. An A round by external investors generally takes place after the founders have used their seed money to provide the proof of concept, demonstrating that their business concept is a viable and eventually profitable one. When investing in companies, private equity investors typically prefer convertible preferred stock to common stock for various rounds of financing, such as Series A, Series B, etc., because of the special features of the security. Convertible preferred stock have features such as dividend accrual and convertibility into common stock, which may become a very profitable exchange. As well, preferred stock will have a higher degree of rights compared to common shareholder. Preferred and common stocks are different in 2 key aspects. First, preferred stockholders have a greater claim to the company's assets and earnings. During times of insolvency, when common stockholders are the last in line for the company's assets, they will not receive any share of assets until preferred shareholders are paid out. Secondly, the dividends of preferred stocks are different from and generally greater than those of common stock. Preferred stock dividends are paid at regular intervals. This is not necessarily the case for common stock. And preferred stock can sometimes be classified as a fixed income security. So now let's look at some mezzanine financing. By definition from Investopedia, Mezzanine financing is a hybrid of debt and equity financing that is typically used to finance the expansion of existing companies. Mezzanine financing is basically debt capital that gives the lender the rights to convert to an ownership or equity interest in the company if the loan is not paid back in full on time. It is generally subordinated to debt provided by senior lenders such as banks and venture capital companies. Since mezzanine financing is usually provided to the borrower very quickly with little due diligence on the part of the lender and little or no collateral on the part of the borrower, this type of financing is aggressively priced, with the lenders seeking a return of from 20 to 30%. So mezzanine financing is advantageous because it's treated like equity on the company's balance sheet, and it may be easier to obtain standard bank financing. To attract mezzanine financing, a company usually must demonstrate a track record in the industry with an established reputation and a product with a history of profitability and a viable expansion plan. Now let's look at some firms versus funding sources. If you look at the lower left, we'll have some lifestyle firms, which are basically you're buying a firm, you're buying a job, basically. As you move to the mid-market with higher return, larger investments, you will see they transition from your personal and conventional financing to angel and VC investment. But you will also note that the percentages become much smaller in terms of percentages of startups, and the numbers become much larger in terms of returns. So lifestyle firms are basically jobs and are limited to personal sources, conventional funding, and now peer-to-peer funding. Angels and VCs are interested in higher capitalization potential because they represent higher return potential. So let's look at the markets. Basically, what you're looking at is that the markets are complementary. Moving from left to right, you will see that a lot of early stage investment is by angels and later stage is by VCs. So the angel information comes from the UNH Center for Entrepreneurial Research, and the VC information comes from National Venture Capital Association. 2/3 of the firms getting VC investments have previously gotten angel investment. So the above numbers are marginally up from 2014, and we see that in 2015, the early stage investments by angel investors were approximately 870 deals that totaled something in the neighborhood of $1.65 billion. You move to the VC side for 2015, and we see that there were mostly late-stage investments with some 4,000 deals and roughly $55 billion invested. So who are angels? Well, angels are accredited investors, and they are defined by the Securities Act of 1933 to be a net worth greater than $1 million, income greater than $200,000 in each of the 2 most recent years, or a trust with total assets greater than $5 million. Part of the responsibility of the angel is to help secure the VC round, and they lay out the blueprint for how they signal VCs about the emergence of new opportunities and how a young operation with slow burn and trackable accomplishments is going to fetch the best investment firms. Unlike institutional investors, that is, venture capitalists, angel investors have diverse backgrounds and perspectives. Their presumptions of how startups should be carried out are not always similar. Therefore, some angel investors can be either beneficial or detrimental to entrepreneurs who are interested in starting their own businesses. Since angel investors invest in fewer companies, their perspectives on how their portfolio startups should be taken forward can be dramatically different from those of the VCs who have experience in investing tens and hundreds of companies. Angel capital is the best type of funding to obtain for your startup once all the seed capital options, that is, money from friends and family, personal savings, bank loans, and credit cards, has been exhausted. The best way to find a principal investor for you is by doing some basic research on angels that you plan to approach. Just ask around. Oftentimes, an entrepreneur in need of capital can ask their business associates and their acquaintances. Your personal accountant, banker, and lawyer are also great sources to ask because many of their clients may be angel investors. Now, a syndicate is a self-organizing group of individuals, companies, or corporations formed to transact some specific business to pursue or promote a shared interest. In most cases, formed groups aim to scale up their profits. The general rule for angels is to fund at levels $200,000 and above. Lower levels may not provide sufficient return to justify the due diligence required for the investment. At the end of the angel round, the angels will typically want to own 20 to 35% of your company. Do not be delusional in terms of business value. There are many online resources to help the entrepreneur connect with angel funding sources. Who are the VCs? Well, venture capitalists are professional investors who specialize in funding and building young, innovative enterprises. Venture capitalists are long-term investors who take a hands-on approach with all of their investments and actively work with entrepreneurial management teams in order to build great companies. Most venture capital firms raise their funds from institutional investors, such as pension funds, insurance companies, endowments, foundations, and high net worth individuals. The investors who invest in venture capital funds are referred to as limited partners. Venture capitalists who manage the fund are referred to as general partners. The general partners have a fiduciary responsibility to their limited partners. The average investment is $2 to $3 million in the first round of investment, and the high end is maybe $4 to $5 million, with the possibility of $6 million for a later stage company. And they typically allocate 3 times the first round for later stage investments. Now, many investors use the 10x rule to judge the market potential of a project or business. That is, they say that if your idea or innovation does not have a 10x effect, the new process cuts production costs by a factor of 10, then it is not likely to provide the returns that you're looking for. And remember, they do have a 10-year time horizon, generally. Some will vary from that. And they do provide managerial and technical expertise. And some will take an active role in management. But they're certainly looking for potential high returns. And they focus on innovation in product, process, and markets. And they virtually all have at least the 10x rule. So what are some of the VC opportunities? Well, they are looking for control, not necessarily a large percentage of ownership, plus seats on the board. So why do VCs look for such big opportunities? And that's to offset their large risks. 40% of their investments will fail. 30% will become the living dead. That is, they will not be generating the funds required to make the 10x rule, and 30% will become successful. And also, importantly, the failures almost always happen more quickly than the successes. And another interesting aspect is that they will determine their exit strategy before they invest. And it generally is going to be a public offering, that is an IPO, or a sale to a strategic partner. And they will focus primarily on Delaware C Corps. So the key to understanding, if we go back to the control versus ownership, the key to understand the difference between control and ownerships is VCs will rarely take majority ownerships, but they will have certain control via the form of stock they purchase, which is typically preferred stock, which gives them a preference upon liquidation, basically first money out, and also spells out certain control provisions. So some tips on venture capital. Understanding your business is absolutely key. It needs to be a problem-solving process, product, or service, and it has to have markets, projections, operations, and show a lot of vision. You also need to know when to raise capital. You should always start early, establish relationships. The process is at least 6 months, and you should plan on a run rate of around $1 million a year, at least initially. And also, you need to realize that VCs look for great teams. For them, it's 90% team and only 10% idea. And then you need to understand which investments are in fashion. So venture capitalists will pick apart your projections, operations, and vision. You probably already have a great instinctive feel for your business, but the challenge when dealing with VCs is being able to succinctly articulate this. Keep in mind that VCs are financiers, so the ability to talk about your operations, growth, and other aspects of your business using numbers is absolutely critical to impressing the venture professionals. So some more tips. Most investors give you between 30 minutes and an hour for your first meeting. You will need to be very crisp and concise in delivering your message. Due diligence is the critical analysis that VCs undertake prior to making a business investment decision. The due diligence process provides business owners, VCs, and other interested parties with reliable and complete background information on the proposed business, whether the deal in question is a proposed investment in or acquisition of another company, so that they can make informed decisions about whether to move forward with the investment. The due diligence process involves everything from reading the fine print in the business plan and legal and financial documents, such as patents. The ultimate goal of such activities is to make sure that there is no hidden drawbacks or traps associated with the business investment under consideration. Venture terms are constantly changing. VCs negotiate investment terms constantly. Most entrepreneurs do so only once or twice in their careers. An experienced venture lawyer will help protect your interests. Keep in mind that the primary goal of your first meeting is to be invited back for a second meeting. Allow yourself a total of no more than 60 minutes for your presentation, including 10 minutes for a product or service demonstration and 20 minutes to answer questions. Do not try to convey everything that you know. Make sure that you present a brief and pithy elevator pitch, one that should not exceed 30 seconds. Anticipate and be prepared for due diligence requests. Establish your credentials and credits of the other members of your founding team so that you are taken seriously. At the first meeting, you are, first and foremost, establishing your credibility and the capabilities of your team. Describe the size of the market opportunity you are pursuing and why there is an inflection point in that market that you can capitalize on. Make sure you have picked a large market. VCs are not interested in investing in the next iPhone application unless it is truly a BFD, that is, big fundable deal. Discuss what is unique about you, your team, your proposed product or service, and your vision. Venture capitalists care about differentiated ideas and products that will enable you to attract customers while erecting barriers to competition. Talk about the competitive environment and why you have or will have an edge over your likely competitors. Discuss how much capital you will require and when, and break it down round by round. In the first round, for example, you may need $3 million, and in the second, 18 months down the road, $7 million. Delineate each round, its time frame, and what you will have accomplished in support of the financing. Make sure you note at what point your future startup will become a cash flow break-even. Lastly, present a detailed timeline that describes your startup's product development cycle, when and how it will be supported from a marketing and sales standpoint, how the startup's revenues will grow, and how this will dovetail with VC financing rounds. By the time you get to C round financing, the timeline should depict substantial customers and revenues and probably an international expansion plan. What you are doing is painting a clear, thorough scenario so the venture capitalists understand at a macro level how you will be going about building your business. Let's talk briefly about crowdfunding. Crowdfunding is the practice of funding a project or venture by raising monetary contributions from a large number of people, today often performed via the internet-mediated registries, but the concept can also be executed through mail-order subscriptions, benefit events, and other methods. Crowdfunding is a form of alternative finance that has emerged outside of the traditional financial system. So the crowdfunding model is based on three types of actors: the project initiator, who proposes the idea and or project to be funded; individuals or groups who support the idea; and a moderating organization, that is, the platform that brings the parties together to launch the idea. As you can see, crowdfunding has grown dramatically in the recent past. Approximately $2.7 billion was raised in 2012. And by the time we get to 2015, we are up to $34.4 billion in crowdfunding activity. That's a lot of money. So let's look at private equity. Private equity refers to a type of investment aimed at gaining significant or even complete control of a company in the hopes of earning a high return. As the name implies, private equity funds invest in assets that are either not owned publicly or that are owned publicly but the private equity buyer plans to take private. Though the money is used to fund these investments comes from private markets, private equity firms invest in both privately and publicly held companies. So we can see from the slide that the money comes from a large variety of places: pension funds, insurance companies, mutual funds, endowments, all kinds of activities, and generally it comes in substantially large amounts. So let's look at initial public offerings. An initial public offering is the first sale of stock by a formerly private company. It can be used by either small or large companies to raise expansion capital and become publicly traded enterprises. Many companies that undertake an IPO also request assistance of an investment banking firm acting in the capacity of an underwriter to help them correctly assess the value of their shares, that is, the share price. And we can see from the slide that approximately 550 companies make IPOs annually, and few companies with sales below 10 million are in the IPO market. So IPOs generally involve one or more investment banks known as underwriters. The company offering its shares, called the issuer, enters a contract with the head underwriter to sell its shares to the public. The underwriter then approaches investors with offers to sell these shares. So the first, again from the list, is to choose the underwriter, negotiate your letter of intent, prepare the registration statement, file with the SEC, and then you wait to go effective, and you need to meet some state requirements. But ultimately, it will all be offered to the public. Some advantages of going public are the ability to raise large amounts of capital. You have an improved corporate image, improved access to future financing. Attracting and retaining key employees can also be a key benefit of going public. Then you can use stock for acquisitions, and you get listed on a stock exchange. Some disadvantages of going public include it's a dilution of the founder's ownership. You do lose some control, and you certainly do lose some privacy. Being a public company, a lot of things are and must be published to the public, and it's reporting to the SEC. You file expenses accountability. You have a lot of accountability to shareholders, and there is a lot of pressure for short-term performance. And then timing is also a very important idea when you go public with your stock. So let's look at some basic sources versus the purpose. So if you have research institutions, typically could be research arms of conventional companies or educational institutions, and what they're looking for is basic research, inventions, and things like that. Then there's self-finance. That's initial startup funds, as well as angel investors that follows closely after the initial startup funds, and then venture capitalists for going firms, that is just after the startup if they have a lot of promise. There's private equity for long-term growth of an established company. And then there's public equity, basically, which is the IPO, and that's a capital investment, and typically a exit for the venture capitalists. And then there's banks, that is financing most of the operating and a lot of the growth needs of a company. So the scope of funding, basically friends and family cover the early stages with a typical round of around 10,000. Each investor puts up a couple thousand. There's very unsophisticated. You're typically passive. They won't have an active part of the business. And a typical investor will only do it once or twice in a lifetime. As we move up the chain, we see that the angels, a typical round is around 500,000, with each investor throwing in 25 to 40,000. They are accredited investors, and they are investing in the entrepreneur. Each investor will have a portfolio of deals, so they will be well spread, and they will also provide some, or may provide some, management expertise. And then at the bottom is the venture capital. Typical rounds around 7, each investor around 3. They are a limited partnership. It's all institutional money. They have general partners and then the limited partners, and they will carry a large portfolio of companies that they are trying to grow and make succeed. As we bring this session to a close, let me take a question from our studio audience. And that question is, what is an exit strategy? Okay. The exit strategy is a method by which the business owner intends to get out of an investment that he or she has made in the past. In other words, the exit strategy is the way of cashing out an investment. Note that most successful exits require considerable planning. There are 5 common exit strategies. The first is merger and acquisition. That is, this normally means merging with a similar company or being bought out by a larger company. The second is an initial public offering, which we discussed, which basically means that you offer shares to the public and you become a publicly held company. The third is to sell to a friendly individual. That is, somebody that is capable of continuing the business and will be willing to pay you for the business at some determined value. The fourth is to make it a cash cow, and that means basically you find somebody to run the business and use the cash generated to fund your next business idea. And then lastly, there is liquidation and close, where you sell the firm's assets and take whatever is left. We have completed step 6 of the 7-step process. This is the main topic in the remaining session. Note the series can be used for one or multiple ideas. So please be with us for our next session, Decision Making, where we will answer the question, should I always make decisions based on my intuition?